Hernando de Soto, who's a Peruvian economist, wrote a book a few years ago called Mystery of Capital, and it's about the developing world. And he argued in that book that property rights, the problems that we just heard about from the Hartford Current, are still very big and alive around the world today. That you can't easily establish who owns what in many or most countries of the world. So that's a problem. That's why we don't see mortgage finance developing there. You can't make a loan. You know, if you go to some small town in some less developed country, you can ask around, who owns this property? And they'll tell you, you know, that's been in such and such a family for a long time. But if you want solid knowledge of that, how do you know, if you're going to base a financial transactions on it, you can't base it just on hearsay, right? I mean, someone else might have a different opinion. So even today, in many countries of the world, the laws are not developed well enough. We don't have property rights established well enough, and we have laws that might inhibit mortgages. For example, in many countries, if you give a mortgage on a property, in other words, you lend on a property, and the person doesn't pay, you're supposed to be able to seize the property, right? But if the court system doesn't function well, or if it's kind of left-leaning and supporting the rights of the person living in the home, you might not be able to get it, or it might take you 10 years to get the guy thrown out of the house. Now, it seems cruel to throw someone out of a house who doesn't pay on their mortgage. But you have to think of the other side of it. If we don't throw them out of the house, no one's going to make a mortgage. You have to be able to get the house, right? That's the idea of a mortgage. The guy doesn't pay, the lender gets the house. And so I think there's a general process of development, improving the definition of property rights and improving the ability of lenders to get the property if it fails, which accounts for the advance of mortgage lending in the 20th and 21st century. Well, let me talk about some of the institutions in finance in the United States. And it's natural to start with commercial real estate. So you see a lot of buildings around, okay? My question is, how are they owned? I don't know whether you think about this. Who owns these buildings? Well, in much of the 20th century and still today, they tend to be owned as partnerships, real estate partnerships, which is different from a corporation. In a corporation, we talked about that yesterday, you might sell shares on the stock exchange if it's public, and it's defined as a legal person. And it has limited liability, so that all the shareholders don't have to worry about being sued as a result. But a partnership is different. And most real estate that's not part of a larger business is owned in a partnership rather than a corporation. And the reason is that they're taxed more favorably. Corporations have to pay a corporate profits tax. Okay, they're double taxed. You as an individual pay an income tax, and your corporation pays a corporate income tax or corporate profits tax. So you're taxed twice. If you incorporate yourself or you set up some friends to do business in a corporation, you get taxed twice. So you don't like that, and obviously you try to avoid that. The way to avoid it is not to have a partnership, not to have a corporation, but a partnership. You have to, the law allows you to form partnerships to own a building, say. So you're building, like, I don't know how, 360 State Street. This is a new building that just went up in New Haven. Do you know this building? It's the biggest construction. Does anyone know who owns it? It's probably a partnership. I haven't investigated that. Or or it's called a direct participation program. So the partnership is an investment. that is offered only to accredited investors. It's not generally available to the general public. And what is an accredited investor? The Securities and Exchange Commission takes it upon itself to define who are accredited investors that don't need the protections of the SEC. Basically, accredited investors are wealthy people, and it's defined in the SEC laws who is accredited. You have to have at least $1 million or minimum income. And so if you are an accredited investor, you can invest in a DPP, all right? Then the income of the property flows through to you as your personal income. It's not corporate income. So it's taxed only once. And you think about that, well, why would anyone form a corporation? Because I don't want to be taxed twice, so why don't we do all business as a DPP, as a partnership? The problem is that the government doesn't want you to do that, and so they have rules about what can form a partnership. And so one of the rules is that they have to have a limited life. So a corporation goes on forever, and it derives a lot of its value from the fact that it lives forever. There's no end date. So we talked about that when I brought up the first real corporation, the Dutch East India Company. The reason it got so valuable is people could see that this was growing as the first multinational. It was this huge company. It had all kinds of deals and alliances and business arrangements, and no one wanted that to end. The value came in the growth prospects for that. But a DPP has to end. So what you do is, it's well designed for a building. You buy the building and you depreciate it over the life of the contract. And then there's an end date. And at the end date, you sell the building to someone else. And then you close down the DPP. You don't hear about these partnerships as much. You hear about companies, corporations all the time. You don't hear about DPPs. First of all, because they don't get so big. They're typically one building, 360 State, for example, all right? And it only lasts for however, 10, 20 years, and then it's gone. Might have a different name. So it doesn't get advertised to the public because it's not available to the public. They can't go around trying to bring you in as an investor because they have to verify that you're an accredited investor. So it tends to be a project for wealthy people. Now, I mentioned that corporations have limited liability. Partnerships do not, in general. But you can have a partnership that involves two classes of partners. There's general partner that runs the business and does not have limited liability. In other words, if the business goes bad and loses money, the general partner can get sued. But there are other partners called limited partners, and they have to be passive investors, and they have limited liability. So what often happens is a DPP is created by someone who understands and knows real estate. Let's get 360 State Street built. You're going to know that eventually because once they open, they're going to open a supermarket in the first floor of 360 State. And I'll bet some of you will be over there because it'll be the closest supermarket to Yale University. But it's all part of somebody's plan. There was some general partner who thought up this structure and got limited partners in and is running the managing the building or hires a manager for the building and has a plan and a closeout plan. The building won't disappear, but they'll sell it to someone else. I really don't know the financing structure of 360 State, but I'm just pointing out it's likely what's happened there. So that has been the modern structure of real estate. And if they mortgage the building, it would be the DPP would mortgage the building on behalf of the partners. So real estate finance in the United States, I might as well write it down, a DPP is a direct participation program. And it's direct in the sense that you as an investor are participating directly in the profits of it. You are a partner. You're not a shareholder. Okay. The DPPs became criticized in the 20th century because small investors couldn't access these. Small investors were confined because they weren't accredited, they weren't big enough or important enough. They were not allowed to invest in these. It was supposed to be to protect them, all right, I guess. But how does it protect them? To subject them to double taxation. So it became a cause that why in the United States do we have most of our investors closed out of these lucrative investment opportunities? Why can't individuals, basically individuals couldn't invest in commercial real estate? And people said, well, people are supposed to diversify. They're supposed to hold different kinds of investments. So what's the, why would this be limited to them? So Congress in the United States in 1960 created something new called a real, I think the chalk is weak. I'm trying to be gentle, and the chalk can't. I'm not being rough, am I? It keeps collapsing. I'll be very gentle here. Real estate investment trusts, or it's abbreviated REITs. These were created in 1960 by an act of the U.S. Congress, and it was a democratization, another example of the democratization of finance. And I believe it started here in the United States. Now they are being copied all over the world. They got off to kind of a slow start after 1960, but they have grown dramatically. And so the idea is that we will allow a company to, well, it would be a trust, to create investments for the general public, for small investors, and they won't be double taxed either, okay? So a real estate investment trust has to follow the law, and then it can invest in buildings. And so maybe 360 State is owned by a REIT. I don't know. But they are not subject to the corporate profits tax. Now, once again, once Congress creates a vehicle that's not taxed, everyone's going to ask, well, I want my company to be a REIT, okay? So they had to define it so that it isn't generally available. It's limited to real estate. So the law says 75% of the assets of the company have to be in real estate or cash. 75% of the income has to be from real estate. 90% of their income must be from real estate, dividend, interest, and capital gains. This is all I think in your textbook, Fibozzi. 95% of the income must be paid out. And there has to be a long-term holder. No more than 30% of the income can be from the sale of properties held less than 4 years. They don't want, real estate churning companies. So if you define all of that, you've got a REIT. And so that invention, which goes back to 1960, it's one of those things in finance. It starts out slowly. Most people don't hear of it. And then it starts to grow. And REITs, and now they're everywhere around the world. Well, maybe not everywhere, but in many countries we have REITs. The U.S. REITs grew in a succession of booms. The first boom was in the late 1960s. when the interest rates in the United States rose above deposit ceilings. There used to be ceilings that the government imposed on savings banks' deposit rates. And so suddenly the REITs were paying better than the savings banks, and the public flocked to them. There was a second boom after the tax reform of 1986 eliminated some tax advantages of DPPs and partnerships. It used to be that the government allowed generous depreciation allowances for partnerships, and people would invest in buildings just as tax dodges, because if you're allowed to depreciate the building very effectively, you can kind of cook your profit so that it's not taxable. And so people were investing in buildings too much. The government created a distortion that encouraged too much investment in DPPs. So in 1986, the government made it harder for, it eliminated a lot of the advantages of partnerships, and that caused the second REIT boom. And then starting in the 1990s with the real estate boom, that the excitement the public got, suddenly lots of new kinds of REITs appeared, and REITs that involve specialized properties and the like. Now they're big, and everyone talks about them. But it's interesting to me that it took 50 years to get as big as they are now. And again, the theme that I'm recurring here, the recurring theme, a couple of them. One is that the finance industry finds it difficult to innovate, and innovations take many years to happen. And secondly, that there's a trend toward the democratization of finance. That if you go back in history, you'll find these same mortgages and partnerships and the like, but they were limited to a small number of wealthy people. And we're moving with the invention of REITs, for example. More and more people are getting involved. Okay, so that's commercial real estate. I wanted to talk now about residential real estate, which is actually bigger. There are more houses than there are office buildings in this country, or there's more value in housing. So this is bigger. In the United States, about 2/3 of households own their own home. It varies across countries, but there are many other countries with similarly high home ownership rates. And this home ownership is a product of government policy that encourages mortgage lending. So I wanted to talk a little bit about the history of mortgage lending and the history of problems in mortgage lending. Now, I already took you back to the silk trade in the Tang Dynasty, but I'm going to be less so far back now. We're going to talk about the United States and the Great Depression. So the Great Depression in the United States in the 1930s, after the 1929 stock market crash, was faced with a severe housing crisis. Home prices were falling, and people were defaulting on their mortgages in great numbers. In fact, the government had to create what they called a homeowners loan corporation to bail people out, and they ended up bailing out 20% of American homeowners. It was a terrible crisis. So what was happening? I've been pointing this out because it's important in the history of real estate finance. Before the Great Depression, mortgages were growing, but I'll say before the Great Depression, they tended to be 2 to 5 years, and they were balloon payment. What do I mean by that? When you bought a house in 1920, you'd go to a bank, and they would give you a loan for 2 to 5 years. So if you bought a house for $10,000, they would typically lend you half the money. They'd lend you $5,000, and the loan would say, you pay interest every month until 2 years has ended, and then you repay the $5,000, okay? And then if you could try to get another mortgage. You come back to us, and we'll do it again if we feel like it, okay? That was the deal. Banks offered that, and it was becoming increasingly common. When we say a balloon payment, what we mean is it's really big. Balloons are big, all right? So you're paying monthly interest, but then in 2 years, you got to come up with the whole $5,000, all right? But, okay, people thought, it's all right. I'll just go back to the bank, or maybe I go to another bank. It's, I go wherever I want, and I can borrow $5,000, okay? So this was the way things were done. But what happened in the Great Depression? 2 things happened. The unemployment rate went up to 25%, A. B, home prices fell, in many cases, by more than a half. So if you borrowed $5,000 against a $10,000 home, your home might be worth only $4,000 now. So what do you do now? You go to a bank, okay? 2 years is up. I got to refinance my mortgage. I go back to the bank, and I show up and I say, A, I'm unemployed and my house is worth $4,000. The bank says, no dice. You're not going to get renewed. So what happens? You're forced to dump your house on the market. You declare bankruptcy. You've lost everything. You've lost your $5,000 down payment. If you buy a $10,000 house and you borrow $5,000, then the other side is called your down payment. So that's what happened. It was happening to millions of Americans. And so the Roosevelt administration decided that the old kind of mortgage there was something wrong with that mortgage. So in 1934, when a year after Franklin Roosevelt became president, they set up the Federal Housing Administration. And it specified that it was trying to get lenders back in to lend to homeowners because it was a catastrophe in the country. I'm not writing this right. So in order to get lenders back in, the FHA started insuring mortgages. And that meant that if you're a mortgage lender and your mortgage, the person you lent the money to doesn't repay you, and the house isn't worth enough, you can get the house, but you might lose money because the house has lost value. The government will make it up. So the government came in with what's called mortgage insurance. And at the same time, the government said all mortgages that are insured by the FHA must be 15-year or longer. And so the U.S. government imposed the long-term mortgage on the mortgage industry. And they said this is better because the mortgage, and secondly, it cannot be a balloon payment mortgage. The government said, this is really imposing too much on ordinary people, that they have to come up with a huge sum of money at the end of the mortgage. So they required that the mortgages be 15-year amortizing. Such mortgages had been offered already by some banks in the United States in the 1920s, but it was innovative finance and too complicated for most people. It never caught on. Let me understand, to amortize means to pay down the balance, okay? So an amortizing mortgage has no balloon payment at the end. A 15-year amortizing mortgage has a fixed monthly payment. You make it every single month. And at the end, you're done. You take your spouse out to dinner and you say, we've paid off our mortgage, we're done. So there's no family crisis at the end. It's a fixed monthly payment. Now, the arithmetic of amortizing mortgages is a little confusing to some people. And in 1934, it took some education. But I want to just describe the amortizing mortgage system. All right, so we're going to have a mortgage of maturity. The maturity of the mortgage is M, and that's in months, okay? So in 1934, they started out with 15-year mortgages, which they thought was pretty aggressive. But by the early 1950s, the FHA was emphasizing 30-year mortgages. That's a long time to pay off on your house. But the idea is, you know, your typical family, they get married and they're buying their first house, they're 25 years old, all right? So let's give them a full 30 years to pay off the mortgage. They'll be 55, kids will be going off to college, they'll still be working. That's a comfortable length of time. Why not give them 30 years? And we guarantee the interest rate for 30 years. No surprises. You just know you have this monthly payment and you've got it. The question now is, how do we decide on the monthly payment? Okay. With the idea of an amortizing mortgage is that you have a fixed payment every month. You have an interest rate, and you want to make sure that the present value of the monthly payments equals the mortgage balance at the beginning. So the initial mortgage balance, that's the amount you borrowed, has to equal the present discounted value of all the monthly payments. So what will I call the monthly payment? Let's call the monthly payment X is the monthly payment in dollars. Okay, so the mortgage balance is equal to X all over R over 12, where R is the annual interest rate, times 1 minus 1 all over 1 plus R over 12 to the nth power. That's just the annuity formula. Okay, so that's the formula that's used to compute. Let me make sure. So I've shown you that formula before. It's the present value of a stream of payments equal to X. Did I write R over 2? I meant R over 12. So what you have to do if you are calculating an amortizing mortgage, if the person is borrowing the amount mortgage balance, and I quote a rate R per year, I have to plug that into the present value formula and find out what monthly payment, X, makes the present value equal to the amount loaned. Now that is a little bit of arithmetic that mortgage lenders would have had trouble doing. It's not that hard to do, right? But I have here a page from a mortgage table from, I found this in the Yale Library. Can you read that? This is from a 50-year-old book. This is before they had computers. And so it was too hard to do this calculation. But I just wanted to, can you read it in back? Sort of. This is for a 10-year mortgage. I just picked 10 years. That was uncommon. That's rather short. Some people would get shorter mortgages, especially older people. You know, if you're 60 years old, you don't want a 30-year mortgage. You probably won't live that long. So they did give out shorter mortgages as well. So this is a page from a mortgage book for 10 years, and this is for 5% mortgage. So it shows the monthly payment for $1,000. If someone's borrowing $5,000, you'd multiply this by 5, all right? But they show it for around $1,000. And the monthly payment, it says monthly payment per $1,000 is $10.61. So what they've done is they've found out X, $10.61, is the X that makes this present value for R equal 5% equal to $1,000. They've done exactly this calculation. Now they show the payment schedule, and the payment every month is $10.61. But what this table shows is the breakdown between amortization and interest. So it shows the principal for each month. So you borrow at the beginning, you borrow $1,000, on this mortgage, and you're paying $10.61 per month. All right? So each month your balance goes down. This balance column, they subtract. Well, the question is, how do you figure it out? You're paying $10.61 per month, but part of that is interest. What part of that is interest? Well, it's 5% of 5% divided by 12 of the $1,000 balance at the beginning. So your initial interest is $4.17. So your principal is the $10.61 minus the interest. So then that reduces your balance. So the initial interest is $4.17. The principal is $6.44. So the balance is $993.56 after 1 month. The next month, they figure what fraction of your payment is interest by multiplying 5% over 12 times the balance, $993.56. And then that comes out to be $4.14 interest. You see, the interest is going to be going down because you're paying off the loan, but your payment is fixed. So the payment against principal is going up. So the first month was $4.17 interest. The next month is $4.14 interest. Offsetting that is the first month was $6.44 being used to pay off your mortgage. The second month it's more, $6.47. Okay? And this goes all the way down. I couldn't show the whole page here. But here, after 6 years, 6 months, your interest is down to $1.74 because your balance is down to $407.61. And so your payment of principal is much higher. So the reason this table is important is that people move and they sell their house early. They don't hold it for the full 10 years. So you have to figure out when someone sells his house after 6 years, 6 months, what do they still owe? Well, they now owe, instead of $1,000, they owe $407.61. So that's the idea of a long-term mortgage. Your interest payments are changing all the time. Your principal payments are changing all the time, but your total payment is fixed. That was an invention, a financial innovation in 1934. And it is now offered, this is called a conventional fixed-rate mortgage, and it's now offered in many countries of the world. However, there's only 2 countries where it's the major kind of mortgage: the United States and Denmark.